All right, let's dive right in. We're cracking open the case file on one of the biggest crypto mysteries of 2025. What on earth happened to the $10,000 Ethereum prophecy? The hype was real, the predictions were bold, the market seemed primed for a moonshot, but the rocket never even cleared the launch pad. So let's get into it.
You remember the beginning of the year, right? This was the question. It was everywhere. The buzz was deafening. The sentiment was just through the roof bullish. You had analysts, big-name investors, everyone pointing to that magic five-figure number. It honestly felt less like a maybe and more like a when. And then, bam, reality came crashing in, and it was brutal. This chart from Fidelity Digital Assets tells the whole story of that first quarter. I mean, look at this. Bitcoin took a hit, sure, down about 13%, but it held its ground. Ethereum, it just fell off a cliff, a staggering 45% drop. Suddenly, the dream of 10 grand felt like a distant memory.
So what happened? I mean, this wasn't your average market dip. This was a fundamental breakdown of the story. So today, we're doing a full forensic analysis. We're going to examine the evidence piece by piece to figure out exactly why the ETH rocket ran out of fuel.
Okay, let's look at Exhibit A. Our first piece of evidence points to a massive problem from deep inside Ethereum's own economic machine. Turns out, the very thing that was supposed to guarantee its success, well, it became its biggest weakness.
For years, the whole bull case, the big idea, was ultrasound money. It was actually a pretty simple and really compelling concept. The more people used Ethereum, the more fees would get burned, and the total supply of ETH would actually shrink. You know, basic economics. Less supply, more demand, price goes way up. This was the narrative that was supposed to power that $10,000 launch.
But the engine completely sputtered out. Instead of becoming deflationary, the supply started to grow again. In that first quarter of 2025, Ethereum flipped back to being inflationary, with the supply ticking up at an annualized rate of 0.63%. The key takeaway here? That whole scarcity story was dead in the water.
And this chart right here shows us exactly why this happened. Just look at that soaring blue line. That's the activity on layer 2s. See, Ethereum's scaling solutions, all these faster, cheaper networks built on top of it, they actually worked a little too well. All the action moved over to them, which meant way less ETH was being burned on the main network. It's kind of wild. In a way, the network started eating its own lunch to get bigger.
So what was the result? For every investor who piled in because they believed in this deflationary digital oil story, this felt like a total bait and switch. The whole fundamental reason to expect a price explosion, that shrinking supply, it just, poof, vanished into thin air.
All right, on to our second exhibit. Because while Ethereum was dealing with this internal identity crisis, the world outside was getting pretty scary. And that caused a huge shift in where investors were parking their cash.
Think about it. During that crazy first quarter, big money had a choice. Over here, you have Ethereum looking weak, suddenly inflationary again, and down 45%. And over here, you've got Bitcoin, predictable, rock-solid scarcity, and holding up way better. I mean, if you're managing billions of dollars, which one do you pick? It's kind of a no-brainer.
And hey, don't just take it from me. This quote from that Fidelity report just hits the nail on the head. With all the economic uncertainty and governments printing more money, investors weren't looking for the next complex tech play. They wanted a safe place to hide. They wanted something with a supply that was actually finite.
And that's really what it all boiled down to. Ethereum was just stuck in the middle. It was way too risky to be a safe haven like Bitcoin, but with its main story broken, it didn't have that crazy speculative momentum either. So the money just went somewhere else.
But wait, it didn't just go to Bitcoin. Our third and final exhibit uncovers a brand new powerful competitor that showed up on the scene. And it was offering something that crypto speculators weren't used to: stable, predictable, real returns.
You know, just put yourself in an investor's shoes for a second. You've just watched your portfolio get crushed by volatility. So what if someone came along and said, hey, forget about guessing the price. What if you could just earn a solid, reliable paycheck from assets that exist in the real world?
Well, that's exactly what happened. Meet real-world assets, or RWAs. While everyone in ETH was seeing red, this whole new world opened up. I mean, look at these numbers. You had platforms like Ondo offering a stable 5% backed by actual US Treasuries. Maple Finance was giving out 9 to 12% on loans. In a market that just dropped 45%, these yields weren't just nice to have, they were a lifeline. This changed the entire game. Suddenly, the choice became crystal clear. Why would you gamble on the hope that Ethereum's price might maybe go up when you could lock in a guaranteed 5, 8, even 12% yield right now? These RWAs just started sucking up billions of dollars in capital that, in the last cycle, probably would have gone straight into Ethereum.
So when you lay all the evidence out on the table, the verdict is pretty clear. Ethereum didn't miss its 10K target because of one thing. No, it was a perfect storm of 3 different forces all hitting at the exact same time.
So let's recap the whole case. 1, its main selling point, the whole ultrasound money story, just fell apart from the inside. 2, at the same time, the scary global economy sent investors running for the safety of Bitcoin. And 3, a brand new competitor, real-world assets, showed up and offered a much, much better deal for the risk people were taking.
And if you think this is just some theory, look at this. This isn't just talk. This is a major market player making a huge move. Token Metrics, a big analytics company, announced they were shutting down their entire platform for helping people pick the next hot crypto. And why? To go all in, entirely, on building indices you can buy on-chain. That is a massive, massive signal of where the market is going.
What this really shows is that the game itself has changed. The whole crypto market started to mature, to grow up. The Wild West days of trying to find that one coin that's going to 100x, that started to fade. And it was replaced by a much more, well, a more traditional approach. Passive investing. Just owning a small piece of the entire market.
And that leaves us with one final and absolutely crucial question. In this new world, a world where Bitcoin is seen as digital gold, where RWAs are offering real, stable yield, and where passive index investing is the new hot thing, what is Ethereum's story now? What is its core purpose? That's the real $10,000 question it still has to answer.